home prices in the United States are up by, or mortgages. I don't want to say home prices because mortgages is really what matters. The monthly mortgages are up 112%, but incomes are up 19.7%. So 19.7%, call it 20% increase in income, but over 100% increase in mortgage. Now, the most important question that people should be asking is, how much are rents up in that same time frame, right? Here's the answer, and you'll be shocked by this, Darren. 19.7% is the increase in salaries since COVID for Americans. 19.6 is the increase in rents. The multifamily market, the rental market, is an exact balance. It's an exact balance, both from the perspective of the renters, which are seeing the same exact increase in rents that they are seeing in their salaries, averaged out over 100 million people. And the pricing market is balanced because prices have dropped 25% because interest rates have gone up.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Neal Bawa. Neal is the founder of Grow Capitis, an online multifamily investor educational platform, experienced syndicator, developer, and his attention to the data has earned him the moniker the Mad Scientist of Multifamily. And in just a minute, we're going to speak with Neal Bawa about the upcoming multifamily distress in the marketplace. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest back, Neal Bawa. Welcome back to CREPN Radio.
Thanks for having me back on the show, Darren. It's great to be back, and what an interesting time to be having discussions around commercial real estate.
Oh, amen to that. Hey, Neal, before we jump in, if you could give just a real quick overview of your background.
Sure. So I'm a technologist, computer science degree, data science background, and have had a successful tech career, successful tech exit. And for the last 10 years, I have been focused on using data science to exploit gaps in the knowledge of the commercial real estate market. And we've used those gaps to buy and build properties in 17 markets, 10 states in the United States. The portfolio is worth $700 million, used to be worth $1 billion, but it's dropped in value. $700 million. We have 1,000 currently invested investors. Most of them are very nerdy, geeky folks like me that see value in constantly looking at data and understanding the value of that data, and then understanding the opportunities in the marketplace that other people may not see.
Yeah, I got to ask you just before we get into the real estate question, the data, the data science. I feel like every keystroke I've ever put in my computer is now being used against me. Is the world shifting as far as people like you and just the whole nature of data science, because there is so much data that can be analyzed? Is there any truth to that, or is that just something I'm feeling personally?
I think in general, your comment is correct. Everything that we're doing is constantly now being monitored and our data is being sold, and there's great value in that data, which is why you keep getting all these free apps. Gmail is truly free. Well, not quite. Google Maps is truly free. Well, not quite. Same thing for Facebook, same thing for Instagram. Well, we're paying for all of these things. We're paying tens of billions of dollars, and we're paying in privacy. We're paying to be targeted by different groups for different kinds of ads. So there is a price to be paid for everything. There is no free lunch. Now, what we do in real estate, though, the vast majority of our data is not of that kind. So, for example, we're not really buying data from Facebook about, behavior of individuals. We're buying data on what large numbers of people do. So I'm not interested in what Darren does. I'm interested in what a million people like Darren do. So I look at what is known as big data, and big data tells me about what the patterns are when millions of people make buying versus renting decisions anywhere in the United States. So we're truly not using the kind of data that Facebook sells to, marketeers, but we're using, traditional big data to make better business decisions.
And just a real quick follow-up. So, but the science of big data, has it not, I mean, is it always been there, or is it more of a recent phenomena in the fact that there's so much data available and the ability to look at it in a unique or different way than it's been looked at before?
It's always been there, but it is now much easier to do it, right? So it's cheaper and easier to get access to data. Things that used to cost $25,000 in the 1980s and used to come in a binder this thick are now available for $99 a month on a website, which basically just gives you all the insights. You click and it just gives you a dashboard with everything instead of sending you a massive pile of data. So it's actually much easier to get access to data, and there's just a lot more data being collected, but it's always been there. And I would say actually that it's less lucrative to be a data guy today than in the 80s, because in the 80s, if you were that one person getting that big fat 2-inch binder and you were able to take that information, put it into a computer, because Excel was still around in the 80s, you could basically make more money back then because there were less of you. So there's hundreds of people like me that are looking at this data. Luckily, not hundreds in commercial real estate, but there's plenty of people that are looking at this data. So it's evolved, but big data has always been around.
Got it. Well, I appreciate you touching on that a little bit. So let's get into it here. We are recording this on what is today, the March 27th of 24. And I think it's important. I don't normally give the date, but I think just given the context of what we're going to be talking about, it does bear noting just to, put in context, what we're talking about. And basically the state of the current commercial real estate market with focus on the multifamily. But how would you summarize? I mean, just in a kind of a sentence or two, just the state of the market today as compared to, say, pre-COVID, and then even in comparison like 2008 when we had the last collapse of the market.
Is that real estate market or multifamily?
Yeah, I'd say let's you can make it as broad or as narrow as you want on that. I
Okay,
think
I'll start with broad and then I'll narrow it down.
Okay.
So the single family market is in a hard to burst bubble. So single family is the most expensive it has been in history. And when I say that, I don't necessarily mean the prices of single family, which are the highest in history. What I mean is what people pay for a monthly mortgage, because that's really the most important number, right? When you're buying a home, price is one thing, but you're looking at, okay, am I paying $5,000 a month in mortgage or $6,000 a month? That's the number that's most important. And so what's happened is that since COVID, the world has changed from a real estate perspective. Home prices are up over 40% nationwide. Some markets are up 70%, right? So 40%. So you say, okay, well, then that means my mortgage increased by 40%. No, the average mortgage in the United States is up 112% since COVID. And the vast majority of that 112% is the increase in interest rates, right? So interest rates have just about doubled. So that has massively increased your monthly mortgage. And then, of course, you've got this price inflation that is not going down. in a fair world, what would happen is that as interest rates doubled, you would see prices come down. You would see a decline in real estate prices in the United States. That's what makes sense to everybody. Now, that's what's happened in the multifamily market, right? Yardi Matrix 2 weeks ago said on paper, multifamily prices in the United States have dropped by 25%. That's the first time one of the big analysts put what I consider a true number on paper, because I think that's the number, 25% decline in multifamily. So what happened is the multifamily industry reacted normally. Interest rates went up, prices went down. The single family market reacted extraordinarily abnormally, very abnormally, because guess what? After interest rates have increased, instead of prices decreasing, they're actually up about 3 or 4%. So they're not up tremendously. They're not up huge numbers, maybe 1%, 2% a year is what we are really seeing, because now we've had interest rate hike go on for 2 years as of this month, right? So the Fed started hiking in March 2022. In those 2 years, if the market was normal, we should have seen home prices also decline by 10, 20%, just like the multifamily market has declined. And that market has not declined because of what is known as the lock-in effect. Unlike the multifamily industry, the single family industry, there was a huge, huge wave of people refinancing when the Fed took rates down to zero after COVID. And as a result, somewhere between 20 and 35 million American families are locked in at interest rates that are half of the current interest rates. So if they were to basically sell their home and buy another home, they would be doubling their rate. Like, for example, I'm at 1.75% on a 15-year mortgage. So if today I go out and buy the same home, so basically I sell my home and buy it back, my mortgage would go from $5,000 a month to $11,500 a month, right?
Yeah.
Same home. So I'm not, I'm just buying back my home, right? For whatever reason. So you see that means that I'm locked in. I can't leave. But, if my wife suggests, let's go somewhere, I'm going to be like, are you crazy, woman? That's what I'm going to say. And that's what a lot of people are saying to themselves. So now you have 30 million Americans locked in, which means that inventory of homes in the marketplace is extremely small, creating a great deal of competition. That competition puts a bottom on the price. And they're not necessarily going up. In fact, most expensive markets, prices are actually down a little bit, like San Francisco. But overall, it's basically making the market flat as opposed to making the market go down. And so the real estate market is in a bubble. It's in an extraordinary bubble. Affordability is at an all-time low, but the bubble is not bursting because of the lock-in effect.
Yeah. No, and the contrary to that is the commercial is you've got resets on the debt, anywhere from 5 to 10 years typically.
Yep. So that market has reacted in an extraordinarily rational way. So I would say multifamily today has reacted in the most rational fashion that you can imagine. And I'll give you a number that will really be stunning. I'm going to go find these couple slides that I have and give you some numbers on this. Bottom line is that, home prices in the United States are up by, or mortgages. I don't want to say home prices because mortgages is really what matters. So monthly mortgages are up 112%, but incomes are up 19.7%. So 19.7%, call it 20% increase in income, but over 100% increase in mortgage. Now, the most important question that people should be asking is, how much are rents up in that same time frame, right? Here's the answer, and you'll be shocked by this, Darren. 19.7% is the increase in salaries since COVID for Americans. 19.6 is the increase in rents. The multifamily market, the rental market, is an exact balance. It's an exact balance, both from the perspective of the renters, which are seeing the same exact increase in rents that they are seeing in their salaries, averaged out over 100 million people. And the pricing market is balanced because prices have dropped 25% because interest rates have gone up, right? So for the first time in my history, looking at this market in the last, since 2008, for the first time, I am seeing the multifamily market in balance.
No, it's encouraging to hear that the numbers are tracking, that the rent is tracking with the income increases, and likewise that the pricing is tracking based on what interest rates have done, whereas the personal residence market is kind of like I said, you've got that lock effect that's keeping everybody from moving.
Mhm.
No, that's fascinating. So let's talk about the multifamily market specifically.
Mhm.
Um, you mentioned that the pricing is down 25%.
That's right.
What are you, how is that translating, or what's the effect in the marketplace? Are you seeing, are sellers resigned to that? Are they, I mean, is there a panic? Uh, are there borrowers that are upside down? Are there, some um, projects that aren't or that are you seeing people turn the keys back to the banks, or what's going on?
Well, so I'd like to give you an answer that's more nuanced than yes, people are giving keys back to the bank, because that is
Sure.
the obvious thing that's happening. People are giving keys back to the bank. But I want to define the problem. Okay. I want people to fully understand the scope of the problem, because it's very easy to just say, yes, people are giving keys back to the bank. So here's the first number that I want to give you. The multifamily industry in the United States, 19.6 million structured units, call it 20 million, plus, of course, a bunch of smaller properties that we don't track, so we don't know how many there are. So those 20 million units, they were worth roughly $4 trillion. That's 4,000 billion. So keep that number in mind, 4,000 billion. And today they're worth $3 trillion. Why? 25% decline, right? So the value of multifamily in the United States has gone from 4 trillion to 3 trillion, 25% up. Now, what is the percentage of multifamily in the United States that is in either distress or in potential distress? The amount of distress is actually very tiny, but the amount of potential distress is significantly larger. So let's do the math on that and see how does that match up against the $3,000 billion number that I gave you overall. Okay, so there are 3,000 properties in the United States that basically have adjustable rate. They were recently purchased, so they're not purchased 5, 10, 15 years ago. Because if they were purchased 5 years ago, they have so much equity built in that the fact that they need to refinance in the next 12 months is a non-event. It simply means nothing. Okay. But if they were purchased in late 2019, 2020, 2021, or 2022, and they have a mortgage adjustment coming up in the next 12 months, that's very consequential. That's very troubling. So let's look at those properties. Let's look at the properties that are really in trouble or going to be in trouble. Well, there's 3,000 of them, right? So if you have 20 million units, apartment units in the United States, and I'm going to assume all of them have 200, units per property, then we have 100,000 properties in the United States. The actual number from Yardi Matrix or CoStar is a little higher than 100,000, but I'm just going to use 100 grand. Just make the math really simple. If you have 100,000 properties, so of 100,000 properties in the United States, 3,000 are in trouble. So that's the first number that I want you to use is 3% of the properties are either in trouble or potentially in trouble over the next 18 months. That also includes the potential property. Now let's calculate the value of those. Let's use $30 million as the value. It's probably a little lower than that, but I'm going to use 30 million. So I'm going to take those 3,000 properties, I'm going to multiply it by 30 million, and the total universe of potential trouble is $90 billion. Once again, $90 billion is 3% of the total multifamily market. So if the total potential amount of distress is 3% of market size, either by unit count or dollars, that's not a distressed market. So I'm simply going to say this statement. The multifamily industry is not at distress and is not at risk of being distressed. The syndication portion of the multifamily market is in distress and is likely to continue being in distress for the next 18 to 24 months. So now we're talking about the 5% of the multifamily market that is the syndicators, the Darrens, the Neals, right? All these 10,000 odd syndicators in the United States that buy and sell multifamily property. We're about 5% of the market. And that 5% is in distress because most, if not all, of those 3,000 properties were syndicated. And that's in distress and will continue to be in distress. But will that mean that the rest of the market is in distress? Absolutely not. right? Let me give you some numbers so you understand it. CMBS is one of the biggest lenders to multifamily. CMBS delinquencies today are at 4.7%. Post-financial crisis peak, 10%. 4.7% is the CMBS number today. The total number of foreclosures is so low in the United States that in 2024, we expect there to be 635 foreclosures in all commercial real estate, office, multifamily, hotels, student housing, senior housing. That is the number that Marcus and Millichap is thinking about what we are going to see. And keep in mind that of those, the majority of those foreclosures are older urban offices. Older urban offices are going to be the majority of those foreclosures, right? What is happening in the marketplace is that with the exception of multifamily, which the banks are refusing to defer, the other kind of distress that we face, which is in office, we are seeing banks defer that distress. So for example, $89 billion of office loans are being deferred, 48 billion of industrial, 45 billion of hotel, 8 billion of retail. These are loans where the banks are saying, oh, no, don't give this property back to me because I may not be able to sell it back at my basis. I might lose money. So don't give it back to me. I'll defer your loans, right? 89 billion, 48 billion, 45 billion, 8 billion. These are all loans in the markets that have more distress, office especially, that are being deferred. Now, you might say, what about multifamily? Are they deferring multifamily loans? No, we have about $270 billion of debt coming up in 2024. 2 billion out of that has been deferred. 2 billion, oh, that was nice. 2 billion out of that 270-ish billion dollars that's coming for renewal is deferred. And you might say, why? Is that a good thing or a bad thing? It's a great thing. Because if banks are saying, I will not defer your loans, then banks are not afraid. Okay? The bank says, fine, you can't pay your mortgage. I'm not going to renew your loan. Just give it back to me. I'm just going to sell it. So banks see a liquid market. So banks are taking one approach for office and a completely different approach for multifamily. And that means a lot. That says a lot.
Yeah, no, I appreciate you going through that because that is I think the common mistake that I think people make is they assume it's all one market, but it's clearly asset class by asset class, distinctly different.
It is. Let me give you one more number, right? CMBS delinquencies, office, 6% delinquents. And by the way, financial crisis, it was at 10%. So that number is not very high, but it's rising fast. All right, multifamily, right? Delinquencies, 2.6%. And here's the thing. There is no up curve in multifamily CMBS delinquencies. Between 2016 and 2024, that number has remained in the same band, right?
Yeah. I was
Office,
gonna say, that's
office is up from 2 to 6, right?
Yeah, the delinquencies has not changed in multifamily, period. Is that
not at all? We are not seeing delinquency changes in the multifamily industry at all. And actually, we're not seeing it in retail either. Retail, fantastic. Hotels, fantastic. Industrial, no delinquency. Industrial delinquency rate right now is 0.4%, historically one of the lowest ever. So when we look at commercial real estate, it's nuanced, right?
Right.
So industrial is the strongest, followed by multifamily. And then you've got others like retail that are very strong, hotels that are very strong because the retail has very low vacancy. Hotels have very high ADR or average daily growth rate. They're doing really well. Even though there's some challenges in that sector, but in general, hotels are doing really well. Their occupancy rates are up and their ADR is up. So they have a double benefit that they're receiving, right? So that would be the equivalent of rents for us. Multifamily rents are not up, rents are flat, right? And our occupancy is down a little bit. But overall, despite the 25% decline, the overall strength of the multifamily market is such that lenders are saying we don't need to defer. It's the market that they're most afraid of, office, that they're deferring. So understand that lenders in the United States, and there's I can provide a list of all the lenders that are in trouble and the banks that are in trouble. There are banks in trouble. There are banks that are going to go out of business. It's almost guaranteed at this point that we'll have somewhere between 50 and 100 banks go out of business over the next 12 to 18 months because they've leveraged themselves on the CRE piece. But the banking system is 4,000 banks, and it's an extraordinarily large system. There is a single bank right now that is over $100 billion, just one bank that is in trouble. So I'll give you the name of that particular bank. Let me just find that number. But there's one bank in trouble out of God knows how many banks we're talking about. Let me see if I can find that information for you. Boom, boom, boom. NYCB, and I think that recently there have been lots and lots of coverage on NYCB. So it's a bank with $116 billion in assets, and 57% of this bank's assets are in commercial real estate. So this bank is unquestionably in trouble. Now, you might say, oh, that's bad. $116 billion bank would go out of business. Yes, but you do realize that we recently had 3 banks go out of business, and their total assets, like Silicon Valley Bank, Signature Bank, and First Republic Bank, were over $500 billion. So we have one bank over $100 billion that's at distress. And then we have 265 banks that are small banks, small to mid-sized bank, less than $10 billion deposits. 265 banks that are at risk. And many of those 265 banks are going to go out of business. So one large bank, NYCB, could be in distress. 16 mid-sized banks, and then 265 small banks are in distress. But when we look at the total amount of money in the United States and the total amount of distress, there's no contagion. I mean, the possibility of contagion is extraordinarily small.
So is the common through line with the banks in distress that they're heavy on the commercial real estate loans?
They are, correct. So but they basically...
Is it more office? Is that kind of the
no, I think it's a combination. I mean, there's multifamily, there's office, there's a lot of stuff, right? So multifamily is a bigger chunk of the loans that these people have. So there is some distress in multifamily. Remember, I said banks are not taking loans back, right? But banks are not extending loans, which means that they're confident that if properties come back, right? But if all of them come back, then prices will fall further, in which case they will be short. And so what they're doing is they're shoring up their reserves, right? So many banks are shoring up their reserves. And you can see this in stock prices are very important to understand. JP Morgan up 27% in 2023. Why? Because only 12% of JP Morgan's portfolio is in CRE. Wells Fargo is at 21% of their portfolio, but their stock price is up 18%. So JP Morgan went up a bit more because they had less exposure. Wells Fargo still went up 18%. But NYCB, that is the poster child bank that's in trouble, 57% of their assets are in commercial real estate. They are down 66%. Right? So you can, by just looking at stock prices, you can see that Wall Street is punishing the banks that have more CRE. And those banks, as their stock goes down, they're in a double whammy. On the one side, the Fed is saying, shore up your reserves. You have problems, right? Your portfolio is losing value. You need to add more reserves. But at the same time, their stock price is declining. So if your stock price is declining, how do you raise money, right? And this is the time when the Fed's saying, raise money. You need to add more reserves. So the banks are adding reserves. I'm watching this process happen, right? So Citizens has added money. Comerica, Truist, Western Alliance, M&T, Zions, NYCB, they've all added money. But NYCB hasn't added enough money. The median loss reserve ratios that the banks have moved up to is 2.5%, and that's a good ratio. NYCB is still at 1.4%. So this is a bank that is at risk. And there's going to be a bunch of medium-sized banks, and NYCB is a big bank, that are at risk. But when I total it all up, it doesn't add up to any kind of banking sector contagion at all.
Well, that's good news. That it's not, or at least at this moment in time, it doesn't appear to be such a widespread potential problem, but more of a, I don't want to say isolated, but there's a few as opposed to the many, which would suggest that that's not going to take the economy down But
It's too small to take it down.
yeah, but I guess the psychological effect of the high interest rates, uh, do you feel like that's something that the market is adjusting to, now that you have, uh, you know, uh, things like Yardi saying, hey, 25% is the discount, where all of a sudden it's a said thing to where now people can start to uh, work with that as opposed to pretend like it's not the case?
Well, I'll say this with a nuance. There is this very silly belief in the industry that seller and buyer expectations should align. Okay. And I will say this, that has never happened in history. So I'll give you an example. In 2008, I was buying one property every month or every other month, and I was paying cash and I was buying them at 70 to 80% discounts. Back then, I thought that the properties were worth $80,000 each. They're worth 400K now, $80,000 each. And the sellers thought they were worth 95. So the gap between my expectations and the seller's expectations as a percentage of the purchase price was the same as it is today, was the same. So this feeling that people have, we will wait until buyer and seller expectations align. Well, you will never buy anything in your lifetime, right? Cheap is cheap. If it's 25% down, it's 25% down. But if you think it should be 30 and they think it should be 23, well, that's normal for the marketplace.
Right.
That's not going to change. But no matter what happens, you'll get 23, right? So there are people who are waiting for buyer seller, expectations to align, and they will be waiting for the rest of their lifetime.
Right. So in the scenarios that you've identified,
Mhm.
Multifamily is essentially healthy, with the percentage of properties that are potentially in trouble sound like it's been a consistent. It's not a blip. It's just a kind of consistent. You've got the older, more experienced investors that have larger portfolios that are not affected, where you have more of the newer syndicators are probably more of the suspects of.
And so there's going to be a wealth transfer there, right? Where
Right.
these older folks that have been holding on to these properties will come in and buy these properties at 25% down from some of the syndicators. So some of the syndicators and their investors are going to be on the capital losing side, and then either experienced syndicators who are swooping in. I'm right now, I'm a vulture. I mean, I'm just making offers all the time and I'm losing offers all the time. I'm really not interested in bidding offers right now, Darren, because what's happening is if I make 50 offers and I lose 50 offers, then one, two, three of those bounce back to me, and those are the only offers that I'm really interested in. So I want to lose a lot of offers, and that's what I'm doing. And I know that many of my experienced friends are doing the exact same thing. They're just we're going to lose offers. We're going to lose offers. I actually don't want to win the offers right now. I want to win them 3, 4, 5 months from now,
When they
because
come back.
when that property bounces back, then I have another 3 months, 4 months after that to close. Well, so I'll be closing, let's say, in November. Well, then I'll be locking in a November rate, because the Fed has always said, last year they said in 2024 we'll cut rates by 3 times. Today they're saying 3 times. Wall Street thought they were going to cut 6 times, then 5, then 4, then 3. Now Wall Street is aligned, thank God, with the Fed. The Fed's always been saying we see the economy moving in the right direction. We see inflation coming down. Yes, we saw a blip in January, February. We're not going to react to it. We're going to cut 3 times. So I want to lock my rate in November. So doesn't that mean that I actually don't want to be in contract in March or April? I want to make an offer in March and April, be turned down, have that bounce back to me in July, and sign a contract in August, and then close it in November when I've had 2 rate declines already, right? So now I'm basically hedging my bets on these properties, and that's what I'm doing. So yes, multifamily at this point is a healthy market. There's some markets in distress. So what I will say is there are markets in the United States, Phoenix is an example, Austin is another, that are distressed because they have too many assets that are going to come to market over the next 12 months. In those markets, I expect that 25% discount number to go to 30, and possibly for some amount of time to 35. But that window of time will be short. So Q3, Q4, right now I'm saying Q3, Q4 is the lowest multifamily price in this cycle. So March of 2022 was the peak. And I'm saying, I'm just going to pick a month and I'm going to say October 2024, which is 2.5 years later, is the bottom of that cycle, which is pretty typical. Cycles are often 5 years long. So at that point, the price bottoms, and then it sticks around the bottom for a while, going into Q1, Q2 of 2025, and then I believe prices will start to rise.
No, that's exactly where I was trying to get a feel for is, who's in trouble, who's potentially going to benefit, and then also the length of the cycle. I mean, that you just described that whole trough of the market is kind of what you anticipate based on everything that's in play now and what's been forecasted as far as rate reductions, and also just the strategy from a standpoint of making an offer that reflects what your what you see the value as, and recognizing it's likely to be rejected, but that as that process plays out and the buyer's not agreeing to any of the, or not the buyer, but the seller's not agreeing to any of the offers, that the reality sets in and then it comes back, and you get an opportunity to pick it up later. And then just that timeline. I mean, 6 months. Uh, I mean, that makes sense, and just that kind of how I guess the psychology of the market is really kind of what I'm, and I guess that sense of are they going to make a deal, or are they going to hold on to it? And in many cases, they can't hang on. They've got there's a deadline, whether it be the financing is probably the primary that's causing that, but there is a cycle, there's a timeline, and this is, I mean, we're looking right at it. It's coming right down the pike. So
Yeah, I think the if you want to call it distress, I mean, this is an adjustment of the marketplace. Distress occurs when prices start to fall and banks start to panic. Keep in mind, the banks can do exactly what they did in the office sector. I gave you those numbers. Banks have extended $48 billion of office loans. They've only extended $2 billion of multifamily loans. The banks have an option. They have a spigot. They can turn that spigot on and defer some loans, and that will reduce the panic in the marketplace because the number of properties will reduce. The banks have a lot of things that they can do here, but the banks are going to let a bunch of properties fail. So I expect hundreds of multifamily properties to fail over the next 9 months, and that will adjust the marketplace.
and you see that being more limited to specific markets as far as just based on the supply.
But the vast majority of them are going to be in the top 20 hot markets. So, Texan markets, Floridan markets. You'll see some in Tennessee. You'll see some in Colorado, maybe some in California for sure. So, these ultra hot markets, I think the top 20 markets are going to be the majority of those failures. Yes. Now keep in mind that every year, dozens or hundreds of multifamily properties fail and go back to the bank, and nobody cares about those. It's just those dozens or hundreds will still happen. I'm just talking about a few hundred on top of that.
No, makes sense. So I got to ask you, so we've talked about multifamily, we've talked about the banks, and we've touched just a little bit on office. What do you see being the forecast for office, just based on the state it's in? I mean, eventually there's the extend and pretend. Does it end, or I mean, how's that market play out?
There is an apocalypse coming for the office market, but once again, it's highly nuanced. So I will say this: older urban office assets will face an apocalypse over the next 5 years. Older urban office assets. I am not seeing much of an apocalypse coming, or a lot of trouble coming for these newer assets, newer urban assets. And I'm absolutely not seeing anything happen that is alarming for suburban office assets. Suburban office assets are doing really well because of COVID. People sort of moved out. So the average employee moved out 10 miles or so, 15 miles or so. So those suburban offices, their occupancy rates are pretty good. They're not great. I mean, you're not making money hand over fist, but you're not in any kind of distress. That's what I mean. But these older urban assets, office assets, are going to face an apocalypse for the next 5 or 6 years. Once again, you are going to see a lot of small banks that have loaned to these fail over the next 12, 18, or 24 months. Now, keep in mind, the office apocalypse is not like any other kind of apocalypse. The reason for that is, while the standard multifamily lease is 1 year long, the standard office lease is 5 years long. So what happens is, as the occupancy reduces, it takes a very long time to reduce. And initially nothing bad happens because companies have the cash to keep paying even though less of their employees are coming to the office. The offices are basically empty, or they're using them at 50% occupancy, 70% occupancy, but they're still paying 100% of their their monthly mortgage. So it only happens that once the offices get to the point where their lease is ending, they say, okay, instead of 1 million square feet, now I'll take 700,000 square feet. And that 300,000 square feet is basically where the problem is. And so we are seeing that as every quarter goes on, office occupancy in the United States, vacancy continues to climb. So it's in around 16 or 17% now. It'll climb to about 20% over the next year or two, but it's a slow apocalypse, right? It's not quick, and it's only happening in one section of the office space. So there'll be problems, and that'll drive a number of banks out of business. That'll drive a lot of office properties to go back to the banks. But again, it is not a large enough segment of the office market that is being impacted for there to be a full-on apocalypse. So I'll just say, it's going to be pretty bad for 5 years.
Yeah. Well, always a wealth of information, and I love the way you're able to get into the data and not just what you think might happen, but just where the data points. It's always delightful to talk to you and hear the data. Hey, Neal, if we could, I'd like to shift gears here for a second. As by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. One is we look to see if we can avoid the risk. If we can't avoid it, then we look to see if we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guest if they can take a look at their own situation. Could be clients, investors, the Fed, market, whatever you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing,
Yeah.
I'd like to ask you, Neal Bawa, what is the biggest risk?
So I'll give you two risks that affect insurance prices and all other forms of prices in the United States. So one is a bigger, sort of more, overarching risk. The second one is well known to us. So the first one is climate change. We are continuing to see devastating impacts of climate change in many markets. It is a political, issue where half of America doesn't want to acknowledge what is happening in markets like Florida and Texas and many other markets like California, for example. But insurance costs are absolutely skyrocketing. And what's interesting is that it's even happening in markets that are not as impacted. So for example, Chicago is not considered to be a market that's highly impacted by climate change. But I just renewed my insurance for a triplex that I own on Brandon Avenue in Chicago. My insurance went up 58%. 58%. And I went through a very detailed process of shopping it. So the climate change is an evolving thing. So it's not one of those, we've had insurance almost double in the last 3 or 4 years. I think we're done with that process. That's a nonsensical answer. I am not seeing any evidence that we are, quote unquote, done with climate change, that we're done with the insurance hikes. There's no doubt in my mind that we will continue to see double-digit insurance hikes, at least into the foreseeable future. So that's really the first biggest risk. The second largest risk is to inflation. So it's not necessarily directly tied to insurance. I'm sure insurance will go up because of it. The second largest risk is that there is now an increasing chance that the United States will get into a shooting war with China in 2027. By 2026, the Chinese Navy will achieve parity with the United States. By 2027, they will be stronger than us, and the chances of a shooting war are high. If that happens, we could have a year with 100% inflation in a single year.
That is the first somebody's brought a specific like that up. I think there's always or there's been a concern with just Soviet Ukraine and also the Israel Gaza, just the conflicts and how they affect the market. And that specifically that's That's interesting, and appreciate you bringing that up.
We are a much larger trading partner with China than we are with Israel or the
Right.
Palestinians or the Ukrainians for that matter, or the Russians. The Russian economy, I mean, Russia is basically just a gas station for the world. And instead of selling our oil to us, they're selling oils to other people. But there is actually no substitute for what China sells the world. Not necessarily just sells us, but sells the world. There's no substitute. If China is in a shooting war and their ports are locked out by the US Navy, you see the most massive inflation that the world has ever experienced.
Yeah, that's a great thought. Wow. Well, Neal, where can listeners go if they'd like to learn more or connect with you?
Two things. So one, my mission, and it's back there, Mission 10K. I am building 10,000 townhomes for those Americans that we've marooned since COVID. Since COVID, 18 million American families, good double income, good money-making families, 70, 80, $90,000 in income, cannot buy a home because the average mortgage requires $112,000 salary. So what happens to these Americans, millennials and younger? Well, my mission is to build 10,000 high-quality rental townhomes for these people, and keep my rents at a reasonable level. So please join the mission at mission10k.com, or you can go to Multifamily University. So type in the words Multifamily University into Google, and you will see dozens of our presentations. Today we talked a little bit about one of those presentations, which is being presented at a conference next week. It's called "At the Precipice: Are Banks Facing a Crisis from the Commercial Real Estate Downturn?" So you have a little bit of a primer into that today. We do a dozen of these presentations every year. 25,000 people attend these presentations. It's always free. There's no upsell. There is no premium tier. There's no subscription. There never will be. It's like a Wikipedia of real estate data information. We talk about climate change. We talk about, what's happening in inflation. We talk about geopolitics. We talk about artificial intelligence, all related to real estate. We tie it all back to RE. So check out Multifamily University.
Yeah, and I got to endorse all that as far as the just the quality of the content. You always bring great information. I encourage all the listeners to check that out. That's good stuff. Neal Bawa, I cannot say thanks enough for doing this again. I always enjoy it. I learned a lot, and I look forward to doing it again the next time.
Awesome. Thanks for having me on.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.